Hi, I'm Jimmy. In this video, we're looking at Alphabet stock, also known as Google, and I'll probably, out of force of habit, keep calling it Google. Either way, in this video, we're going to look quickly at Alphabet's business, then we're going to look at their most recent earnings update, as well as trying to come up with a fair value for Google stock using discounted free cash flow. Ultimately, we're trying to answer the question, should we buy their stock here, or do we sell it? Yes, I do own shares of Google myself, but we'll touch a bit more on that in a minute. But for now, let me tell you real quick about an investing platform that we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. We do a valuation live stream. We do a portfolio live stream where we talk about my portfolio. We build the different portfolios. Plus, we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. Okay, now let's jump over to Google's revenue by segment. So we can see that they have three primary segments, with advertising representing the largest amount of revenue that they've done over the past 12 months. But we can actually break that advertising revenue into sub-segments. So the largest segment is clearly their search. This is traditional Google search. The advertisements that pop up when you search for something, that's where this revenue lands. Then they have their network revenue that represents about 12% of revenue over the past 12 months. Network revenue is, let's say you go to a website and that website has Google ads on it. Well, that website gets a piece of the revenue, Google gets a piece. This is where that revenue lands. Then we have the YouTube revenue. This is the revenue generated from YouTube advertisements. The video advertisements you see on YouTube, that's where that revenue goes. Then they have Google Other. That represents about 10% of total revenue. Google Other is a mix of a bunch of different things. The revenue that they generate from their Google Play, that's part of it. The revenue they generate from selling the hardware, Fitbit watches. Yes, they bought Fitbit back in 2021. That revenue, that goes here. If they sell the Nest or the Pixel phones that they make, all of that revenue lands in Google Other. Interestingly, if you're a YouTube Premium member, if you're a subscriber to YouTube Premium on YouTube, well, the YouTube Premium membership actually goes under Google Other, not under the YouTube category. YouTube category is just advertisements on YouTube. Google Other includes sort of everything else. Then they have Google Cloud. That represented about 9% of revenue over the past 12 months. Now, it's important to point out that that's actually up from 7% of revenue in 2021. Past 12 months is the past 4 quarters. So past 4 quarters, that segment is growing, which is a good thing because that's a big part of their future plans. That includes things like their Google Workplace, their enterprise services, and ultimately the revenue generated there could be either companies or people that pay subscriptions to get access to the Google Cloud, or perhaps on a consumption basis. Either way, that will end up under the Google Cloud business. Their final segment is what they call Other Bets. We can see that represents a super small percentage of their total revenue. This is ultimately long shots that they're taking. So the company says, hey, we want to come up with, think of some wild idea that Google might come up with 20 years from now, 5 years from now, 10 years from now. They fund it with $50 million. They put it to the side and see if it goes anywhere. It's not meaningful enough to impact their business right now, but if something plays out there, it could end up being really good. They call it Other Bets. I've seen people call it long shots, things like that. So it's a small piece of the total revenue, but it's out there, so it's something we should pay attention to. Okay, now let's jump over to their most recent earnings numbers. So this is their earnings over the past few quarters, and we can see in the most recent quarter, Google actually missed analyst estimates by a decent amount. They missed by about 30 cents. And they've missed for the past 3 quarters. In fact, the last time that they met analyst estimates, or that they beat analyst estimates, was the 4th quarter of 2021. Now, I think it's important to remember that one of the primary reasons that the company is missing analyst estimates over the past 3 quarters is that although, yes, 2021 was an exceptionally good year, we'll see that in a second, but there's been broader macroeconomic issues. The economy globally has struggled. In fact, I think a better way to look at this chart is if we eliminate the analyst estimates, I think it becomes much clearer. And when we do that, we can see that over the past 4 quarters, numbers have been trending down from an analyst perspective, from an actual earnings per share perspective. But we're going to come back to this in a second. For now, let's shift over to revenue numbers. So we can see that revenue going back to 2012 has, broadly speaking, been fairly good. It's trended higher most of the time. But I think the important one for us to pay attention to here is the big jump that happened in 2021. Now, one of the reasons for this big jump is that coming out of a very bad 2020, well, there was a lot of pent-up demand that built up during that time period. So when the economy gradually opened heading into 2021, well, Google especially saw a giant push of revenue, which partially explains why we saw a big jump in Google's numbers. Now, another point to consider is that many people who were perhaps not big online shoppers, online shopping became almost a necessity during 2020 for many people. So it really increased the adoption rate, which at the end of the day should be a good thing for Google's business. Now, this was such a big jump for a very large company. I was curious to see if we could break down those numbers a bit further. We can actually break out the revenue growth from 2020 to 2021 by segment. And we can see that there was good growth at every segment for Google. When we look at their individual numbers, well, the individual numbers show that everything, look at YouTube. YouTube grew by nearly 30% in a single year. These are already pretty good numbers. By the way, from a valuation perspective, every one of these will probably do very, very well as their own independent business. But we'll come back to that in a minute. For now, let's look real quick at the total revenue numbers for each segment. And I do think it's important to remember that we're going to have that analysts are expecting at least some pullback or a possible pullback in revenue for 2022 and continued growth in 2023. So when we switch back to the revenue chart, well, I think that the mistake that many Wall Street people are making is that they are looking at the individual drop from 2020 that's expected to go into 2022. Now, I did take more conservative numbers. Other analysts are expecting the drop not to be nearly as bad, but many people are expecting a decline, and I think that's hurt the stock. For us as long-term investors, I think it makes way more sense to look at the bigger trend. If we look at the bigger trend, well, Google's doing quite well. The real anomaly here was the jump in 2021. If analysts, even these conservative numbers, if analysts are correct, well, the numbers could just keep moving higher, which could be a great thing for us as investors of Google stock. Meanwhile, what Wall Street is doing is Wall Street is focusing on the quarterly declines that we looked at before. So when we look at Google's earnings, if we get caught up on individual quarters, an individual drop from one quarter to the next, well, that could end up really hurting us if we are truly long-term investors. I think we can get wrapped up in the noise. We are far better off staying big picture and ignoring individual volatility, including numbers that unexpectedly beat too much. Don't get too excited either. Don't get too depressed. Don't get too excited. Our advantage is that because Wall Street pays such close attention to individual quarter numbers, well, Google's stock has really taken a beating over the past year. This is a chart of both GOOG and GOOGL. As you can see, they practically moved together. But over the past year, this stock is down about 35%. That's more than the S&P 500, which is, to me, a little bit crazy for a company that has so much cash, so much potential future upside, and at the end of the day, they've got a fairly wide moat that is unlikely to go away anytime in the near future. Okay, now let's jump over to their free cash flow numbers, and then we'll try to look at the fair value of the stock to see if Google is actually worth buying today. So these are their free cash flow numbers going back to 2012. And we can see that, broadly speaking, this looks very similar to Google's revenue numbers. In fact, that chart, that arrow, is copied and pasted from the Google revenue chart. So directionally, it's nearly identical, except for the primary difference being in this time period here where there were more investments being made. And that's the thing, is that revenue should be far more stable than free cash flow. If a company makes big investments, well, revenue wouldn't be adjusted and free cash flow would go down that year. Ideally, if you're spending money now, that will help in the future, but we can see, broadly speaking, directionally, it seems to be heading in the right direction. Again, we're ignoring the outperformance that happened in 2021. Okay, now let's jump over to the fair value calculator that we mentioned before to see what Google stock is worth today. So before we jump into the details, I just want to point out real quick that this calculation is actually for GOOG shares. GOOG represents Google Class C shares. There's also Google Class A shares, which is GOOGL, and then there's Google Class B shares, which is not publicly traded. It's primarily held by insiders. If we're curious, the primary difference is Google GOOGL, Class A, they get 1 vote per share. Class C, shares that I own GOOG, no votes per share. And then Class B gets 10 votes per share. If we're curious why Class A and Class C shares trade virtually the same, well, it is because Class B controls all the votes. So at the end of the day, the other two, it doesn't really matter who has votes and who doesn't. Now, I had gone with Class C shares because they were doing buybacks at the time for Class C, but they've now initiated it for both, so it's somewhat irrelevant. Either one should do just fine if we're interested in it. Now, before we jump into that, I just want to tell you real quick about a feature that we added to the website we're actually going to use for this analysis. First, if you were to click on the button, it depends on which device you're using to access the website, but it shows analyst estimates broken down a bit further. What are they showing for cash flow from operations? What are they showing for capital expenditures? If you click the other button, well, you can actually get what the historical numbers are. We don't need the historical numbers here because we already looked at charts of that information. So we're just going to focus on the primary information that gives us our calculation, gives us our fair value. Now, if we're curious, discounted cash flow takes a look at all future cash flow, estimates for all future cash flow, discounts it back to today, and comes up with what it should be worth today. We are getting a fair value of $118 per share if we use the cash and debt adjusted calculation. If we don't, we get $111 per share. That is because Google has almost $120 billion in cash, which is just an obscene amount of cash for them to be sitting on. But either way, I think that one of the important points, the reason why I wanted to show the expanded view of analyst estimates, is that we can see that cash flow from operations is growing at a decent pace, which is exactly what we would hope. Capital expenditures, which is how much the company is spending to basically maintain and grow the business, is growing, and it should be growing, but it's not growing as much as cash flow from operations, which is exactly what we want to see. So if we believe that these analyst estimates are possible, and from what I've seen there, they don't seem totally unreasonable. If we believe they're possible, well, the stock should be closer to $118 per share right now. Right now, it's trading below $100 per share, so this looks like a great deal. This is the largest position in my portfolio, and I have averaged down a few times, and I'd like to keep averaging down, assuming that it doesn't become, I don't want it to become too large in my portfolio. I'm just trying to keep them all about somewhat balanced. But overall, I'm a huge fan of Google stock. I'm a huge fan of the long-term prospects for this company, and I think that they have a large margin of safety that is very unlikely to be touched by any competitor in the near future. So if you'd like to sign up to get access to this website and join our private investing community, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.